Stuart Schweitzer is the global market strategist over at JPMorgan Private Bank. And when stocks were falling in the spring, he told us on air they would rebound, which is exactly what happened. Good to have you back.
Great to be back. You really challenged me back then.
I did challenge you.
But I said I was sticking to it.
So, and you think the gains continue next year?
Yes, but it's going to be a year just like this in the sense that there's going to be a lot of up and down. And I won't be the least bit surprised if we have a reversal along the way, kind of like we had in the spring. I don't know when it'll come, but there are a couple of reasons why it might happen.
And they are?
You really want to know, right?
Well, I mean,
yeah, okay.
I do.
We're talking about the headwinds here, right? Why would the reversal happen?
Yeah, why? No, I got that, Matt. I got that.
No, I was just clarifying. I'm asking for my own. I didn't get it, so.
Okay,
It's
yeah.
Friday. It's Friday.
So yeah, we're all in a good mood. Market's up. So I think there are two main reasons. One is the sovereign debt crisis in Europe, which there's a lot of funding needs that have to be met in the spring, I think, in Europe, in the banking community, and there's going to be more angst over the situation in Europe.
How much angst do that? When you talk about volatility, are you talking about 5% swings, 2% swings? What are you expecting?
Well, I don't know, but let's talk about the second risk, and then we can talk about the magnitude of the swing.
Right. Because
the other risk, let's put it this way. I think we're getting stronger. We're going to grow a good solid 3% plus, maybe 3.5. I had a colleague this morning say, no, it's going to be 4. Whatever. It's in that zone. A good year for growth. Mm-hmm. A good year for growth. And then the emerging markets still growing very strongly. Right. And Europe is holding its own on the whole. I mean, the periphery's down, but Europe as a whole is holding its own. So that adds up to a lot of demand for commodities. And it adds up to higher commodity prices, I think. And I don't know about you, but I remember 1993, rates are low, Fed stimulus continues into the early stages of a recovery, and then 1994, commodity prices become really problematic. We see interest rates shoot up like that. And if that happens, and let's face it, we've had now, 40 to 50 basis points since the Fed chairman broached QE2, and people said, no, this is going to take rates down, and instead rates have gone up. So I think there is some risk that rates will go up next year. That's my expectation. Bond yields will go up next year, and that there will be, right now, higher bond yields are part of the good news because they're symptomatic of growth. Too much of a good thing?
Right.
Not a good thing.
But that doesn't slow down the move in the equity side of things?
It does temporarily.
What will the Fed do to sort of counter that? I mean, you still expect the Fed to stay pat on its extended period for the whole year next year, I assume. Well,
don't assume anything. If growth is strong enough, they won't even necessarily need to complete the well, it depends whether you count it as 600 or 900. Personally, I think they're going to try to stick to that game plan. Personally, I think that'll be it. There won't be any more needed.
600 billion and that's it.
I think so. So I don't know when this hits, and it may not be till early 2012. But if you ask me, could we have a setback? Yeah, and by the way, I think I'll be a buyer on that dip if that happens, because how do we get into the mess we got in? It was because we had pretty much unbridled growth fueled by unbridled credit availability, and if we'd had something that sort of checked us and stopped us along the way, we wouldn't have gotten so overdone. So I think if we have something that checks us for a while, it actually could be good in the long run.
I mean, it sounds like an almost ideal.
You're saying the worst news for the stock market next year is that the economy does so well.
The worst news for the stock market next year, yeah, is that there's a setback along the way. A setback along the way is the best news.
What about unemployment? I mean, if we still have unemployment at almost 10%, that can't be good news for the U.S. economy.
It's certainly the level of unemployment way too high. It's going to be getting better, I believe.
Companies are going to start hiring, in your view.
Oh, I think they are ready. So think about it this way.
And they have already,
they've only a little bit, though. So the work week is up a lot. The work week, on average, I know this is geeky, but it's recovered 70% of its recessionary declines. Employment has barely recovered any of its recessionary declines. Now we're going to see a switch from a higher work week to more employment.
Hey, I got 20 seconds. So you're upbeat. What's your best investment advice for the new year? How should people be positioning themselves quickly?
So I think equities, where U.S. and Asia, emerging, U.S. and emerging, but with an emphasis on Asia for me.
Okay.
I want to be short duration in fixed income. I still want to have some credit exposure. I also want to have some hedge funds in my portfolio. Now, I know everybody can't do that, but hedge funds are the asset. They're not really an asset class, but they're the category of assets that if you have the right mix, you can get moderate returns with not that much risk.
Okay.
And that's a good thing.
Hedging.
It is hedging.
All right. Hey, Stu, thanks so much for joining us. Stu Schweitzer of JPMorgan Private Bank. We are